Now, the problem is, if you make that LLC something such as an S Corp or a C Corp, you could be shooting yourself in the foot from a tax planning opportunity. Hi everyone, Payton Gillis here of REI Tax University, where we talk all things tax planning for real estate investors. And today I want to get into a topic that deals more with legacy building and generational wealth building and leaving things behind to your children. So I want to take you through a scenario that a lot of you may be interested in doing. So let's say you go through life and you build up your rental portfolio and your assets, and you go in and you get properties. And let's just take one property, for example. You go get it, it's $500,000. It's a rental investment property that you get, you cash flow off of it, it grows, you take depreciation on it. So you hold that for 30 years and then you pass away. In 30 years, that property is on your books for $0. So if you sold it the day before you died, and let's just say that property is worth now $1.5 million. In 30 years, it's gone up in value. So if you sold it, you'd have $1.5 million that you're selling it for. It would be on your books at $0 because it's fully depreciated. You would have capital gains taxes on $1.5 million. So about 20% tax that you're going to pay on that. Now you could do things like 1031 exchange, and there's strategic ways to defer that, but it's there. The capital gains tax is there some way, shape, and form for you. Now, what if you die and you leave that property behind to your kids? Do your kids have to pay capital gains tax if they were to turn around and sell that property? And the answer is maybe. So you really comes down to how you've structured your entities and how that property is held. So let's get into how you want to do that to help avoid your children being in that situation and putting them in the best situation to continue utilizing everything that you've built to build their own wealth. So typically, you're going to look to get your rental property held within an LLC or some type of legally protected entity so that you're protected from it. If something happens to the property, you're protected. Now, the problem is, if you make that LLC something such as an S Corp or a C Corp, you could be shooting yourself in the foot from a tax planning opportunity. Because if you do so, in that situation we talked about, when you pass away, your children will get the property at $0, the same basis as you. So you had it 500 down to 0, it's worth 0 now to them. They get it, they turn around and sell it, they've got tax of 1.5 million. Or they hold it and it keeps going up, they got to pay the capital gains tax on all of that. But if it's not held within an LLC or an S Corp or C Corp or another C Corp type of entity, and instead it's held in an LLC that's maybe a disregarded entity, so it just goes on your personal tax return, or maybe it's an LLC partnership. When you pass away, the child heirs that property at the fair market value that it is on that day. So in our example, they would get it for $1.5 million. So on their books, it's worth 1.5, meaning they could turn around and sell it. If they sold it at 1.5, it looks like they paid 1.5 for it, $0 in gains that they're picking up. If they didn't sell it and they wanted to hold it, they can start depreciating it again from that $1.5 million basis. So they can start realizing significant deductions there and significant tax breaks themselves. And then if they decide to sell in the future, they can determine, okay, we're going to 1031 exchange, or we're going to just pick up the capital gains. Maybe it's up to $2 million and they have to pick up the difference on that. But they don't have to pick up the difference from the 1.5 to $0 that you would have had to pick up if you give it to them through one of these strategic LLC partnerships, LLC disregarded entities, and they have the ability to get that step up in basis. So if you follow us, if you watch any of our content, if you have a good accountant, follow any good accounting advice for real estate investors, you are going to hear them say a lot to beware of holding your rental properties in an S Corp or a C Corp. If you have an accountant or hear someone telling you to do that, to keep them in an S Corp or a C Corp, get a second opinion. This is one of the big issues with it. There's several others. This is probably the biggest that I see with it, is that you're not going to get that step up in basis that most people are looking for, because we didn't even get into it, but you might use that property, you might sell it throughout your life and use a 1031 exchange. So you've deferred those capital gains and you've got maybe a couple properties or bigger properties, and then you want to leave those to your kids. Well, if you do it effectively, all those deferred capital gains go away when you die and it passes to them and they get that step up in basis. So definitely something that you want to consider, be smart about. If you are currently sitting there with your property in an S Corp or a C Corp, reach out, talk to us, talk to another accountant about how you can untangle that and how to strategically do that. It may be hard. You may have to do some things. You might have to take a little bit of a tax hit to do it. There's some strategic ways to go about it, but there's no kind of easy way oftentimes. And so we prefer much better if you start it out right and you never get something into the S Corp or C Corp. But if it is, talk with someone, talk with a qualified real estate accountant who can help you kind of consider the options for untangling that and getting that out of the S Corp or C Corp. The other thing is this is totally about rentals, guys, and rental investments. This is not about your flips, your wholesale, your realtor commissions, all those. Those are a completely different topic. These are about rentals, your passive assets that you're building up. Guys, I appreciate you tuning in. If you found this video and this content helpful or useful, feel free to follow us, like us, get more content. Go over to reitaxu.com. If you haven't checked it out over there yet, that's in a real estate tax planning community that we have. It's a paid community to help real estate investors like you utilize tax planning strategies, understand them, and put them to use to reduce their taxes every year. Appreciate you guys following along.